Hey, welcome to the HireMyVA Team and Business Building Podcast, brought to you by ugozi.com and Victory. In this podcast and at HireMyVA, we help you to reclaim your freedom through hiring and thriving with virtual assistants without breaking the bank. And of course, that means your bank, the most important bank to you. And I'm Dave Braun, and I'm here with my partner, fantastic business mentor and coach. But of course, the most important thing is my good friend, Larry Broughton. Larry, give us the good word.
The good word is that I'm still Larry Broughton and you are handsome Dave. Hello. Hi, David.
Hey, Larry. Still up in the mountains enjoying it.
I see that. I'm glad you're there. I'm a little envious as I sit down here in sunny 75-degree weather.
It's cool up here, but clean and fresh. Some of the leaves, we see a few leaves here, a few chipmunks, that kind of stuff.
Oh, that's good.
But it's nice. It's cool.
Good.
Hey, recently we had a question in one of our coaching sessions, and I thought it might be good for us to expand upon, because it was just kind of like a little side note question, but I think it's pretty fundamental for those of us who are growing our businesses and wanting to expand.
What's that?
So the question is really, what does the term mean, equity share, or what does equity share mean? And so, I mean, you are the foremost expert in life and leadership. Of course, CBS News said that, and I agree. But I'm going to give you my limited understanding, and then you can take it from there. So, so basically, a share in a company. So what a share is, I thought we'd first define that. A share in a company or corporation is a portion of the ownership, and it's often used for raising capital for a business, right? Or as a way of giving ownership to the company, to investors, or, even your team members. That's an option. So it's a way to divide up ownership of the company. And so, for example, in its most simplest form, say you start your company, maybe you have 5 people. So 5 people give you like $10,000 each. And you, say yourself, put in $50,000. So the total value that you put in, the seed capital, so to speak, ends up being $100,000. So what you could do at that point is you could then issue 1,000 shares. And then 1,000 shares means each share is valued at $100 each. And you'd, of course, give yourself 500, and each of your investors then would have 100, right? So, but I think one of the important things about this, an aspect of it, if you're going to do something like this, there's a whole bunch of other considerations, right? And Larry, I've had some experience working with you in this with some of our clients now, but you've had many years of experience of doing this and doing this the right way. So I thought it would be great for you to take over that conversation from here on out.
Well, I think you're on the right path here, and I'm glad that you said in its simplest form, because the truth is there are various levels of stock and shares that have different levels of value. Generally, the shares that come in first are worth the most, because that's considered at risk money, right? But conceptually, when we're talking about equity, it's pretty easy to understand. In finance and accounting, equity is just the value that's attributed to the owners and the investors of the business, right? And there are generally 2 types of equity to value. There's the book value and there's the market value. That's what we need to remember. Book value and market value, right? Yeah. The book value of equity is calculated simply as the difference between the assets of the business, which would be cash on hand or cash in the bank, your accounts receivable, the value of your equipment and the like, right? So it's the difference between assets and liabilities of the business, which would be loans, credit card debt, mortgages, outstanding balances on lines of credit, money that you owe to your vendors. All of this should be recorded on the company's balance sheet. So it's really just assets minus liabilities, right? So that's the book value. The market value of equity is based on the current share price, if we're talking about a public company, or it's based on the value that's determined by investors or valuation professionals, right? Because there are companies that you actually will come out and do valuations on the business. So this is the account that appears on your balance sheet. It might be called shareholder equity might be owner's equity or stockholders' equity or net worth. So your book value may be one number, Dave, but your market value may be and likely is something very different. And that's sometimes based on market conditions, inflation, interest rates, supply and demand, market trends, the trajectory of your revenue or your expenses. Okay. So really there's book value that impacts equity. I'm sorry, that's equity or the market value. Okay. So in the hotel industry, for instance, you might do the book value and see, well, gosh, this is the value of it, but crying out loud, it might be some multiplier of that. So assets in the simplest form, assets minus liability, what's left over. If it's a positive number, is equity. Okay. If your liabilities are bigger than your assets, that's negative equity. You don't want to be there. Okay. Which means you owe more than you are actually worth.
Okay. So, and so some of the context of this question I remember was relative to bringing somebody else into the business, kind of as maybe a partial partner or something like that. And then we were talking about, okay, distributing some equity or maybe creating shares. So if somebody really wants to maybe start doing something like that, is there a process or a method or some advice they should really start with?
Yeah. Talk to your attorney and your CPA about it, because it's going to depend on what type of legal entity you have. If you're an S corporation, for instance, distributions of your distributable cash flow, as well as, so distributions will need to be distributed. It's called pari passu of the ownership interest. All right. So if you own 90% and you've got a partner who has 10%, any disbursements that go out, return on investment has to go 90-10 without exception. And the same goes for if there's a capital call. Let's say that you don't have enough cash to pay your bills. You need to pay that. You need to come up with 90% of it, and your partner needs to come up with 10%. It's different if you're a LLC. You've got a lot more flexibility in that. So, for instance, I may only own 20% of the entity. I may hold 20% of the equity, but depending on how the LLC is written, I may get 90 or 80% of the distributable cash flow.
Okay.
Right. So talk to your attorney, talk to your CPA about first, what kind of legal entity do I currently have? Because I think the case that we were talking about is that the entity was already formed.
Yes, already formed. Yeah.
And so then how much do I give this potential partner, future partner, right? And so you just need to ask yourself, what's my relationship with that person? How much of an active role are they going to play? Like, are they going to be an operating partner? Are they actually going to be in the business doing something? Or are they just going to be a passive investor where they give you the money and you give them some return on it? So this is where having a board of advisors or a mentor is really important, because the devil is in the details.
Oh, yeah.
And these types of things. This is why when we started, we said, in its simplest form, this is how equity works in the business, right? Assets minus liability. That's your book equity, right? So a sophisticated investor, though, if you're not doing a PPM, a private placement memorandum, where you're going and raising, $1 million through what's called subscriptions, right? Where each subscription gets a certain percentage of the business. If I'm just going after one person, they're more likely to negotiate. Hey, if I'm going to give you $100,000, I want blank percent of the business. And you're going to say, well, that sounds great, but I'd rather you have this blank percent, right? This is kind of the stuff you see on Shark Tank, for instance. I'll give you this much money for this percentage of the business. What Shark Tank doesn't show you is all the negotiations that go on behind the scenes afterwards. Okay. So, so I would encourage you, have a board of advisors. That's an ideal that you can bring this to them beforehand. Keep in mind, board of advisors don't have financial, responsibility for the business, but they're there to just advise you, and or have a mentor who's got experience in this case, right? Who can walk you through it. But you should also have a CPA, tax accountant, and an attorney you can talk to.
And it seems like a good CPA or attorney that you talk to would be able to ask you the right questions.
Of course.
Like trying to help you to, they'll figure out or ask you questions so that they can uncover really what you want to do, what the long-term thing is, and as well as give you pluses and minuses of each direction that you want to go.
Dave, you used a word in there, a good attorney and a good CPA will do that. I have had CPAs and attorneys who say, well, what do you want to do? And I'll draft it up. Like, I'm paying, you're my professional services team. Help me with this. I didn't hire you to be an order taker, right?
Yeah, right.
Help me flush this out, right? And so if you're getting the runaround with a CPA or an attorney, they're probably not that experienced in this space. Okay.
Yeah. Or they're just looking to make a buck and not really help you, right?
Yeah. Yeah. They're out there, sadly.
Yep, for sure. Okay. Yeah. Well, that's a really good introduction on, that the term equity share and that topic.
Yeah.
Other advice, parting advice, so you think we ought to give to somebody on this?
I would say make sure that if it's going to be someone who's an operating partner, like they're going to play some daily, weekly, monthly role in the organization, that you know who they are, that you've worked with them in the past. I've seen it too often where someone, just because they're willing to give you money, you bring them in as an operating partner and you don't share the same core values. They've oversold their ability, whatever it is. And I've made these mistakes too, right? But the best partnerships that I've been in where we've actually had somebody have a piece of equity is that I've worked with them before. Mm-hmm. Okay. Done projects together, known them, whatever. Like you and I, let's be honest. You and I, when we first started working together and we said, hey, let's consider being a partner, we practiced what we preached. We did a project together first to see who's showing up. Are both of us actually bringing value to this, right?
Compatible? Do we have different strengths, the two of us? And that
right.
Kind of stuff. Yeah.
Right. Because we were going to be operating partners, working partners in the businesses, right? So I would encourage somebody to do that. But if it's a limited partner who's giving you cash for a certain exchange of equity, I would just make sure that this is what's called I want to say sophisticated investor, but that's not the right term, that they know what they're doing, okay? Mm-hmm. That they've invested in things before. Because the last thing you want them to do is when their going gets tough, it's like their last $100,000 and they're begging you, oh, I need my money back, right? You don't want that. And you don't want somebody, what I have found, Dave, sadly, because I've raised millions and millions and millions and millions of dollars. I should do the number someday, but lots of millions of dollars, over $100 million before. And it's oftentimes the person who has the smallest equity stake in the business is the squeaky wheel, The people who have larger amounts tend not, they're sophisticated. Yeah, it is sophisticated. They're more sophisticated investors, right? So I guess there's a couple of nuggets in there.
Yeah, you reminded me of a couple of situations where people have taken on an investor and that person has given them part of their kid's college fund because they believed in the idea so much, or their retirement account, taking a bunch from that. That's heavy responsibility.
Here's another tidbit. And as soon as I start the story, I know you will know who I'm talking about. If you take investment money from someone, you have a responsibility to them to communicate with them on a regular basis, monthly and quarterly, at least quarterly, with accurate financials, with an annotated summary of how the business is doing, how the market is doing, what your market penetration is, what capital improvements have been done, what your action plans for sales and marketing are in the future. That should be done on a regular basis. I think it's very bad to take money from someone and then you never communicate with them, particularly for the first couple of years when people are on pins and needles. Did I make the right decision by putting $100,000 or $10,000 or whatever it is into somebody's business?
Yeah.
Right? Because you're wondering, are they going to be a success? Or not. And the ones that are really good at this, Dave, who communicate on a regular basis, I have seen their investors invest in other projects of theirs, even if the first 1 or 2 deals don't go very well, because there are market conditions for some reason, or there's reasons that are sometimes outside of the business owner or entrepreneur's control, that sophisticated investors will understand. But they'll say, well, gosh, they've been handling my money with integrity, even if you invested $100,000 and it's now worth $80,000. But if you've done it with integrity and you've communicated effectively, they say, well, gosh, I can trust this person, right? So I would say over communicate. If you're taking money from someone, over communicate and be honest. You know what I'm talking about. Be honest with what you're doing with the money.
Yeah. And even if they're an operating partner, regularly meet together with them, have honest conversations, keep each other up to date on what's going on in the business.
Yeah, that's right. Yeah.
Okay.
All right.
Well, let's wrap this one up.
Good.
All right. Well, thank you everybody for joining us today. And remember, building a team is the way to reclaim your freedom. And we're to help you with our course and community and our white glove service, where we find a rockstar VA for you. So 3 things we'd love for you to do right now, and we'd really appreciate it. Number 1, subscribe to this podcast if you haven't already done so, either on your iPhone or Android phone, and on YouTube by hitting the subscribe button and clicking on the little bell next to it to get reminders. Number 2. Yeah.
Sorry.
I didn't know I was going to hear effects. Oh yeah. You threw me off.
I'm sorry.
No, that's fine. We're having fun. It's our podcast. We're doing what we want. All right. Number 2, I want to get back on it. Give us a rating, preferably 5-star, or leave us a comment below this video. Any comment, it'll help us to get the word out, folks. Please do that. And then number 3, go to HireMyVA.com for more information on our course in the community and obviously our white glove service. And remember, though, even without experience, you'll learn how to prepare for, hire, and thrive with virtual assistants. And even if you do have experience, I know you're missing something, because we've dealt with a lot of clients that have had experience and they are missing things. I bet you are too. Well, so Larry, we're helping all kinds of folks, even folks with experience. So we'd love to help you too. Just go to HireMyVA.com for more information.
Yep. Hey, folks, God bless you. God keep you. My favorite, God hold you until we see each other again. Go do something significant today. All right, my friends. Peace out. We'll see you next time.
Bye.
Bye.